In this episode, we're reviewing the top questions we received in 2016.
Access granted. Access granted. Access granted.
All right, welcome. This is episode 4 of Access Granted. Thanks very much for joining us. This is a pretty exciting episode because this is the kind of the end of year episode for us for 2016. And although we didn't start this too long ago, what we wanted to do is review a number of the good questions or great questions that we received in 2016 from clients, new clients, and people alike. So
Prospects, friends.
yeah, exactly. So Brent, why don't you take it away? Why don't we start it off?
Grant, this is a good one. A little bit of a green rush here, I'd say.
Yeah.
It's a question we're getting all the time. Should I be buying into marijuana companies, marijuana stocks?
This is we've received this question a lot from clients and again prospective clients. We've got obviously our own feelings on this. This feels a lot like the tech bubble did to me. Back in the early 2000s there, because there's a lot of speculation going on about which companies are going to make it, and then we've seen a lot of big rise in stock prices and share prices for these marijuana producing companies. I think that the short answer is that it is purely speculation at this point. And should you be buying into it? I think if you feel like you want to take a gamble on something, it's a gamble. We all agree that there's probably there's going to be a demand for marijuana.
Yep.
I mean,
There'll be people who make a lot of money off of it.
That's correct. I mean, there's no doubt about that in my mind. And wherever you sit on the fence of whether that's a good thing or a bad thing, it doesn't really matter. And we just believe that there's going to be demand for it. I don't think there's any question. The question really is which companies are going to be the successful ones in that. And that's why I say it feels a lot like the tech bubble, because there's a lot of speculation over which companies are going to be great and these ones are going to make all this money and so on and so forth. Without actually having any clear proof and any earnings in these companies, there's no way of knowing which of them are going to be successful or not. It's just a pure gamble. It's a bet.
And I think that leads me to another point I wanted to make on it is the only thing we can really control with regards to these companies. We're not sitting there running the company day to day, but the only thing we can control as a shareholder is what we pay for the company, the price that we pay. And right now, a lot of these companies are wildly overpriced. People are buying into them. And anytime whether it's a good company or a bad company, if you overpay for a company, you're adding risk into your portfolio that you don't need.
Yeah, no, 100%. So that's our viewpoint on it right now, is they're very expensive for what these companies are actually doing. Will some of them make money? Probably, but there's no way to know which ones. And so tread very lightly on those companies is our opinion.
Yeah. Grant, another question. As I'm talking to people all the time on the phones, dealing with they first started investing with their bank branch financial planner, and they continue to do that. They've never been approached or talked to a specialized wealth management group. When I'm talking to them, they often don't know what is the difference. I have a financial planner. What makes a specialized wealth management group different?
Yeah, no, that's a really good question, and I think that the basics of it is this: there's nothing wrong with dealing with the bank branch for certain groups of people, and I think it's a good solution for some people. What you just have to know the difference, and that's the point. With a bank branch solution, and I would throw any of the bank branches in here. It doesn't matter which bank it is. You're going to get a little bit. You're going to get a less customized solution. It's designed for the masses, essentially.
Yep.
So when you're looking at your investment solutions, you're going to get a mutual funds solution, typically that's designed for millions of different people in Canada, not specifically for you, your family, or your business. And likewise for any planning work. So less customization. little bit lower quality of advice because it's less specialized as well. You know, when you look at a full service wealth management team like ours, we employ people like our Cedric Paquin, who's our senior tax advisor, who's a chartered accountant. So people like him come in and provide advice to our clients specifically to their unique tax situations, whether it's corporate structures or their family situations. So we have specialists that we bring in to provide specialized advice for you and your needs. At a bank branch, you're not going to get that level of service. So it's a little bit different there. It's going to be a lot more broad-based.
Important to note as well, they're often handcuffed, or most of the time, almost all the time, they're handcuffed to using only the company that they work for, only those mutual funds. So if you're working for a specific bank X, you're selling bank X mutual funds.
Yeah, so again, less options. When you're working with a full service team like ours, you get a broader range of investment solutions, broader range of solutions, period, actually. So
when it comes to managing the relationships and dealing with the actual advisor, you know, how many relationships do wealth management teams manage versus your typical bank branch advisor? I think that's a key difference there as well.
Oh yeah, for sure. I mean, again, I can only speak for our team situation, but we limit the number of relationships that one of our advisors will manage, specifically to keep up the level of service and the personalized service, more importantly, that we can provide to our clients. And that's, again, just a different mentality from the bank branches where it's more on the volume side. They want more and more and more. Whereas as a team, we will limit the number of relationships that we have. Just again, we're looking to have personalized relationships, and so the only way to do that is to limit the number of people that we deal with in some cases. But also, you know, it would become impossible to manage thousands and thousands of clients, and so and
the way that a specialized wealth management group does.
That's right.
Very hands-on.
So if we want to always be there for our clients to pick up the phone when they have a question and always be there for one-on-one services, you know, we need to make sure that we're maintaining that. So
I'd say this is another big question for 2016, just given where interest rates are at. You know, money is cheap. Lots of individuals we talk to, deal with, have mortgages, debts, and you know they're trying to invest and build their net worth at the same time. And the question we get is, should I be paying down my debts now? Should I be investing? What should I be doing with this money?
Yeah, actually, really interesting time for this question because money is so cheap. Interest rates are so low. It's tough to pay it off because it's basically free money. So I get that, and I understand where a lot of people are coming from. I think you need to distinguish between what's good debt and bad debt too at this time, because you know, good debt is typically tax deductible debt. If it's used to earn money, if it's used to earn money for your business or personally, then you can deduct the interest on it. So that would be what I'd consider good debt. Low interest rate debt is better than high interest rate debt, of course. So when you're talking about maybe a home equity line of credit where you're paying, you know, around the prime plus a half or so around 3.2% versus credit card debt, which is at 19-20%. Obviously, you'd prefer to have that lower interest rate debt at any time. So this question is really individual, depends on the individual and your comfort levels for debt. But I would say this, and everybody needs to be aware of it. We're still at historical lows for interest rates, and so money is very cheap right now. It's not always going to be cheap, and so I think this is also not only a good time to be borrowing for investing and doing those types of things. Again, depending on the individual, it's also a good time to pay down debt that you're uncomfortable with because it's not always going to be as cheap as it is, and so you should take advantage of this opportunity that we're given. And maybe look to consolidate debt and also look at debt elimination strategies. It's a great time to do that.
And I think you touch on it a little bit there. It's individual to each person. Each person's comfort with being in debt and owing money. If owing money is something that keeps you up at night and you're stressed about, get rid of it.
Yeah, something I do have a concern about in the Canadian economy is there's been a lot of personal borrowing in the last number of years because of how cheap this money is, and so I think people need to be really aware of that in their personal situations and just be aware that this money isn't always going to be cheap. And so if you've locked yourself into a large amount of debt at a low interest rate, keep in mind that if it goes up, 1% over the next 10, 15 years, what position is that going to leave you in? And maybe even a shorter term. But, just be aware that interest rates will go up. Don't get yourself caught.
Well, 2016 was a fantastic and exciting year for CGW.
Lots of good changes, lots of exciting times for us, and we're really looking forward to 2017 and what that has in store. So stay tuned for more episodes of Access Granted, because lots more questions are coming in. Feel free to send us your questions. Email us at cgwfamilywealth@nbc.ca. Go to our website, cgwfamilywealth.com. And keep those questions coming. We love hearing from them, and we love to get you in an episode with your questions. So with that, we're going to move on. Ready?
Aim.
Fire.